Fantastic. Thank you, Simon. Well, I'm very excited to be here today. My name is Dan Blystone. I'm the Chief Market Strategist at Scandinavian Capital Markets. Simon's been doing a fantastic job leading the event so far, and really excited to be speaking alongside a great lineup of speakers. So my presentation today is 6 trading strategies. Simon asked me earlier, are these my favorite trading strategies? Well, these are the trading strategies that I wish I had known earlier on in my career. I think they would have been very helpful to know about all of these things when I started out. And so that's kind of the thinking behind the presentation today. So without further ado, let's jump right into it. First of all, a little housekeeping, a couple of disclaimers. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. You shouldn't invest money that you can't afford to lose. And then secondly, the hypothetical trading disclaimer. The information in this webinar is provided as general market commentary and doesn't constitute investment advice. So in other words, the specific examples that I'm using in the presentation, I'm not suggesting that you actually make those trades. So with that out of the way, let's get into the meat of the presentation today and look at what we're going to be talking about. So we're going to be talking about 6 broad different types of strategies. We're going to talk about breakout strategies. We're going to talk about strategies for trading the news. We're going to talk about price action. That's something that you hear about so much these days because I think fundamentally it's something that works and will continue to work as long as there are humans trading the markets. We're going to talk about trend trading strategies. We're going to talk about correlations, how you can use an understanding of different markets and how they relate to each other to your advantage. And finally, we're going to look at the carry trade, which is a means of earning the interest rate differential between 2 currencies. So I like to start out my presentation with presentations with quotes. Pulled out a classic here from Jesse Livermore. There's nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. This a quote reminiscent of Ecclesiastes in the Bible, the passage that starts with or contains there's nothing new under the sun. And the inference being, of course, that the markets are not random, that it is possible to consistently make a profit in the market, trading the markets. So starting out with breakout strategies, today we're going to cover a strategy that's derived from the classic opening range breakout strategy by a guy called Toby Crabell. Not so famous, but he's a phenomenally successful fund manager and also a technical trader. So he's not like a lot of fund managers. A lot of fund managers are more fundamentally based, whereas Toby Crabell is basically started out as a technical trader. So the opening range breakout is one of the most important indicators of daily price direction. Another famous trader who used breakout strategies is Richard Dennis, a famous commodities trader from Chicago. He's famous for the turtles experiment, and he used to use breakouts on quite long-term strategies. So he'd be looking for breakouts, looking at the weekly charts and so forth. So they might only get one trade every couple of months, something like that. But he's another example of a breakout trader that used breakout strategies. So something that's interesting about breakout strategies is that they teach you to do something that's kind of counterintuitive, or something that many people are naturally reluctant to do, which is to buy at the high and sell at the low. So I think there's certainly value in that, and learning about strategies that teach you that it is possible to be successful doing just that. So the breakout strategy that we're going to look at today is called the London Opening Range Breakout. You may have heard of it. It's an intraday strategy that allows you to capture the strong trends and big price moves that can launch early in the London trading session. And so why trade the London Open as opposed to the New York Open or the beginning of the Asian session? The reason is that London is the Forex capital of the world, so about 30% of all FX transactions take place during the London session. Additionally, the session is highly liquid, so the spreads tend to be more competitive. That doesn't matter so much for this strategy because it's only taking one trade a day. So the size of the spread isn't that important. More important is that the London session is typically the most volatile session, and the session in which trends form, which often continue until the open of the New York session. In fact, we're seeing a nice example today taking place. So what you often see is a nice trend forming, nice follow through, and that's the kind of thing that traders want. So let's look at the strategy basics. Currency pair is cable, the pound against the dollar. Time frame is the hourly chart. What time is the London Open? It's at 8 a.m. London time. Let's look at the strategy rules. So you want to use the highs and lows of the previous 5 hourly candles to create the range. So you go long, you buy using a buy stop order, place 3 pips above the high of the range, only when price is above the 50-period simple moving average. So we use the 50-period simple moving average as a filter. You only take long trades when price is above it. Conversely, you go short using a sell stop order, place 3 pips below the low of the range, only when price is below the 50-period moving average. So let's take a look at a chart and see how this takes place in reality. So this is an example from a while back. We can see the range that took place during the Asian session here. So we got the lows of the range here, and we can see that at 8 a.m. London time at the London Open, there's a breakout to the downside and a nice fluid move taking you down which would have resulted in a nice profit. Keep in mind that we're using the 50-period simple moving average here as a filter, so we were only taking short trades in this instance. If it had broken out to the upside, we wouldn't have taken the trade. So let's take a look at stop losses and how you control your risk with this strategy. So you want to place your protective stops 4 pips below the low of the range when you're long, and 4 pips above the high of the range when you're short. So to go back here, we're short, we put our buy stop above the high of the range, basically. You can see the logic of that. And then if price moves in your favor after the first hourly candle, you want to cancel your initial stop loss and use a trailing stop loss order. So I wanted to pull up a more recent example. So I looked at today's chart, and there's actually a really nice example of a breakout trade here in today's chart. So we can see the range that took place in the 5 hourly bars preceding the London Open during the Asian session. And we can see the breakout taking place here. Again, we're under the 50-period simple moving average, so we're only looking for short trades. And we can see that there was a nice breakout here, and I did another screenshot. It followed through to the downside and went all the way down to this support level here. So it'll be interesting to see what happens later on in the day with this trade. One of the nice things about this strategy is that it's kind of a set and forget strategy. It's something that you could actually do if you have a day job. It doesn't require you to be in front of the computer all the time. It's only 1 trade a day. So it's a good strategy for sort of dipping your toes into the market and learning about breakout strategies and how they work. Another useful thing to know when trading this strategy is to use average true range to kind of get a realistic profit target. So average true range is going to show you basically the range of the market over a set number of periods. So it's a good idea to set the ATR to 20 periods to see what the average range was on the day that you're making the trade. So remember, when you're looking at ATR, you want to move from the hourly chart to the daily chart and just get an idea of what the range of the market was for the prior 20 periods. Was it a 100 pip range? Was it a 50 pip range? Was it a 150 pip range? So for example, if you had the market's been very volatile and you had a large range, like 150 pips over the prior 20 days, you might be more ambitious with your profit target and look for 150 pip profit target, or at least maybe take some off at 100 pips and some off at 150 pips. That's the idea behind it, basically. Okay, so next up, I wanted to cover trading news. I interviewed Adam Button recently from Forex Live, and he's a big news trader, and I think it's one of the best ways of trading the market. So I wanted to cover the different ways people approach trading the news. So to begin with, let's talk about trading the news generally a bit. With multiple economic releases every day, there are many opportunities to trade the news. Since the dollar is a part of 90% of all currency trades, US economic releases tend to have the most pronounced impact on the market. So as most of us probably know, the key market moving economic indicators are the interest rates from the central banks, particularly the Fed, employment reports, particularly non-farm payrolls, and the unemployment rate out of the United States, GDP, retail sales, and so forth. So let's talk about a couple of different fundamental approaches to trading the news. By studying the economic data prior to a news release, traders can form an opinion on the likely outcome and place their orders ahead of time. So, for example, the employment component within the Purchasing Managers Index report and the initial jobless claims report can give us a clue as to the outcome of the monthly US employment report. So if you want to dig into these prior numbers, they can give you a clue to what the later release might be, and you can place your orders accordingly. That's a hard strategy. That's really not one that most retail traders undertake. This is something more people at the major banks are doing, and I'm not sure if I recommend this strategy because it's so hard and involves so much research. Another approach, which is more doable, is to wait until the release of the report and trade based on how the figure came in relative to analyst expectations. So for example, if UK retail sales missed expectations by a wide margin, a trader might take a short position in the pound, since such a result is typically bearish for sterling. So these economic indicators are basically confidence indicators for countries. So it's a fairly intuitive concept that if you have a poor employment report or a poor poor retail sales figure come out that misses expectations, that's going to be bad for the country that it's tied to. It's UK retail sales, it's going to be bad for the pound. If it's US retail sales, it's going to be bad for the dollar. So trading this kind of strategy successfully comes down to really understanding how the currency pair reacts in relation to how far the figure came in outside expectations. And you can get an idea of that by just watching the releases and how price behaves in reaction to that. And the big banks are doing that also. Then you've got a technical approach to trading news. Some people have no clue about what's going on fundamentally and don't look at that at all, the pure technical traders. So technical traders can also take advantage of the volatility produced by economic releases. So for example, a technical trader might look for a major breakout, again, now we're talking about breakouts again, in price in the wake of a release or an announcement. So in this scenario, the news causes price to break through a technical level, and the trader enters the market with the expectation that price will continue to trend in that direction. So here we've got an example looking at an ECB meeting, and there was a surprise with a more dovish than expected monetary policy statement saying that rates were going to stay at record lows, and we can see that price broke through a support level here, and there was a really fluid move to the downside. Okay, next we're going to move on to price action strategies. And we're going to start out talking about pin bars, another pattern that you'll surely have heard about a lot in the market. This term was coined by Martin Pring technical analyst, Martin Fring, short for Pinocchio bars. He called them that because they lie about market direction. They're reversal patterns. So the long wick of the pin bar is like the long nose of Pinocchio when he lies. Personally, I love these setups. They're highly accurate reversal patterns, particularly when they're properly identified and when they occur at a support resistance level where there's a confluence of other indicators. So on their own, they're not necessarily that powerful, but if they take place at support resistance where there's confluence with another technical indicator, they're great patterns to watch. So let's look at an example here. We're looking at the pound against the Australian dollar. So we've got an uptrend starting back here in April, looking at the 4-hour chart. Nice uptrend taking place here, and then we've got a textbook pin bar here. Price goes up to a new high. What happens? The buyers are in retreat. They go back all the way back to roughly where price opened here, and then price reverses here. We had some confluence here with stochastics moving from overbought into oversold. So there was some nice confluence going on there. But when you look at pin bars, basically there's no hocus pocus or this is all about the psychology of the market. And so what took place in this bar here is that the market got bid up. The buyers lost their confidence, so much so that price went all the way back to close, basically very close to the open. And that tells you that there's potentially an imminent reversal in price. How do you trade pin bars? Where do you get into the market? Typically, pin bars are traded by entering below the low of the bar itself. So when price trades below the low of the pin bar itself, that's the short entry. And then people have different ideas on where to place their stop. Some people place their stop loss above the high of the pin bar. Some people place it halfway up the pin bar. But that's basically the thinking around this pattern. Next up, let's talk about inside bars. It's probably the second most commonly used price action indicator or setup. So an inside bar is a 2-candlestick price pattern that equates to the Harami pattern in Japanese candlesticks. The pin bar, incidentally, equates to the shooting star. So this pattern is defined by a candle completely contained within the range of the previous candle, also called the mother bar. The inside bar should have a higher low and a lower high than the mother bar. This pattern indicates that the market is consolidating and reflects indecision and uncertainty. Inside bars can be traded both as continuation patterns and reversal patterns. So let's take a look at an example. So here we're looking at the silver daily chart, and we can see here that we've got a series of inside bars. So here's the mother bar, in which all these bars are contained. And so we've got a range with the high and low of the mother bar. So we're looking for potential breakouts to the upside or to the downside. Now looking at this chart, since we're in a downtrend, I would favor the potential breakout to the downside. That would be the higher probability trade. But like I said, they can be traded as continuation patterns or reversal patterns. So you could also trade a breakout to the upside. So we talked about pin bars, we talked about inside bars. One strategy that you hear about less is looking at falling momentum. So another important aspect of price action trading is to understand what the size of a candle body tells us about the momentum of the market. So a series of long bodied bullish candles or green candles reflect that the buyers are in control, while consecutive long body bearish candles indicate that the bears are in charge. So you've got these Marabosers, right? These long bodied candles. Additionally, when the size of the body of the candle gets progressively smaller, this tells us that momentum is waning. When the body of the candles gets progressively smaller when approaching an important support or resistance level, this shows a loss of momentum and indicates a possible reversal at that support or resistance level. Conversely, if you have a series of long body candles, Marabosus, occurring ahead of a support resistance level, that suggests that price is more likely to break through that level. So let's take a look at an example of this, falling momentum. So here we have the Aussie, and we have price falling, starting out with some great momentum here. Look, we got this big fat Maribozu, but we see the momentum waning a little bit as we come to the 200 period simple moving average, which is a very important support level, particularly on the daily chart. So we have this declining momentum approaching an important support level. And what do we see? Price bounced right off the 200 and reversed upwards. So that's an example of using the falling momentum along with a technical indicator support resistance level, giving you a clue that that price might bounce at that level. Okay, next up, let's talk about trend trading. How are we doing for time? We're about 20 minutes in. This is one of my favorite strategies if you have the time to spend a lot of the day in front of the computer. So we're going to look at a moving average crossover strategy. We're using the 15-minute chart for our entry signals. I would recommend using either the pound against the yen because it's really volatile and it trends nicely, or the euro against the dollar, euro dollar. I would probably start with euro against the dollar because of the spreads are much tighter. If you have spreads of a pip or less than a pip, it can really help you if the market's flipping and flopping and you're not getting the trends. Whereas if you've got a pair where the spread's larger, that can really hurt you. So it might be better to start testing the system on a demo with the euro against the dollar if you're going to look at it. So buy entry, 5-period EMA, the exponential moving average, crosses above the 10-period EMA. Why the EMA instead of the SMA? Why the exponential moving average instead of the simple moving average? Because the exponential moving average puts greater weight on more recent price data. So they tend to pick up changes in trend faster, basically. That's the short answer. And so conversely, we got the sell entry. We want to see the 5-period EMA crossing below the 10-period EMA. In terms of a filter to try and optimize the success of the strategy by looking at other time frames, only take long trends when price is in an uptrend on the 4-hour chart, and only take short trades when price is in a downtrend on the 4-hour chart. I mean, you can look at other time frames also. If you want to add additional filters, you might look at the daily chart also. So let's take a look at the strategy in action. So basically here we've got an example. I mean, you look at any currency pair that's trending, you'll see the multiple instances of the crossover take place. And it looks very easy in retrospect. It's not so easy when the market's flipping and flopping back and forth. So you really want to be in a trending market when you're using this strategy. But in any case, so looking at the EMA crossover on the 15-minute chart in the euro here, we can see that there was a bullish crossover took place here and a nice fluid move to the upside. You can further improve your chances of success by looking for confluence from oscillators on the 15-minute chart. So you might pull up RSI or stochastics and look at these oscillators moving from above to below overbought to give you confirmation for a sell signal, or the inverse for a buy signal coming from overbought, coming from below from overbought. And then your exit is when the reverse crossover occurs. Okay, next up we're going to talk about correlation strategies. This is how I traded when I very first started in the market. I was trading stocks and I was trading Cisco and watching the S&P 500 basically to lead. what was going on with Cisco, and it worked pretty nicely. So a popular way of using correlations in trading is to watch two highly correlated currency pairs and look for one to serve as a leading indicator. In other words, when watching two highly correlated pairs and one makes a move, you might anticipate a move in the other in the same direction if they're positively correlated, and in the opposite direction if they're negatively correlated. This approach can be more effective when combined with an understanding of technical analysis. So for example, if one pair breaks through an important technical price level, this is going to improve the odds that the closely correlated pair will react in the same way. So let's take a look at a couple of highly correlated currency pairs. Here we can see two pairs that are completely unrelated, Aussie against the dollar and the New Zealand dollar against the Swiss franc. Well, I suppose the Aussie and the New Zealand dollar are correlated, right? But we can see that these two pairs are very highly correlated, moving almost in lockstep at certain points in time, like here, for example, or here. So in a scenario like that, you might use one as a leading indicator for the other. And then you can also look at inversely correlated currency pairs. Here we got the Australian dollar against the Japanese yen and the euro against the South African rand. And you can see that they're almost a mirror image of one another. Jamie Sedley brought up this example in one of his pieces of analysis that he published recently on Scandex. It's an interesting one that I hadn't looked at before. The Australian dollar, which I knew is a commodity currency, and the Aussie is often thought of as a risk-sensitive currency and sometimes as a proxy for China, because China is Australia's largest trading partner. But what we can see here is that the Australian dollar and copper have an extremely high positive correlation. Again, moving almost in lockstep. So we talked about using correlations and trading based on having one as a leading indicator. There's other ways of approaching correlation, for example, more of an arbitrage style strategy. So let's talk about arbitrage for a second. So strictly speaking, arbitrage refers to the simultaneous purchase and sale of a similar or identical financial asset in order to capitalize on an imbalance in price. Strictly speaking, arbitrage refers to an identical financial asset. So for an example of that would be the same stock trading on a US exchange and an international exchange also. So for example, buying the stock of one company on exchange and selling the same company on a different exchange when prices diverge. A similar strategy can be used in the Forex market using correlation. When two currencies are historically highly correlated, a trader can try to capitalize on a reversion to the mean by simultaneously buying one pair and selling the other. Let's take a look at an example of this arbitrage type of strategy. So if you look at the correlation tables, we can see that the Aussie against the yen and the New Zealand dollar against the yen have a high correlation coefficient over multiple different time frames. So they got a high correlation coefficient, not just over a month, but over a month, 3 months, 6 months, and a 1-year time period. This statistical data suggests that over the prior month, the pairs have diverged more than usual and may revert to the mean. So here we can see the chart of the Aussie against the yen versus the New Zealand dollar against the yen and the periods in which they diverge. So here we can see they're totally in lockstep. And here we can see the two pairs diverge. Now, how do you capitalize on that unusual behavior in these two pairs? Well, what you might do, this is the Australian dollar here in the candlesticks, and the New Zealand is in purple. So what you would do in this scenario is when you see the two highly correlated pairs diverge, is you would buy the New Zealand dollar against the Japanese yen and sell the Australian dollar against the Japanese yen and wait till they come back and converge. So in this instance, you would have bought it here, for example, and you would have made money on the New Zealand dollar against the Japanese yen, and you would have lost money on the Australian dollar against the Japanese yen, but you would have made that spread when these prices converge. Okay, finally, let's talk about another non-directional trading strategy that's been popular among banks and hedge funds, but is less well known among retail traders, the carry trade. So this strategy was most famously used with the Japanese yen in the mid-1990s, and again in the period leading up to the financial crisis of 2008. So it was a phenomenally successful strategy for big banks and hedge funds back in those days. It's based on buying a high interest yielding currency and selling a low yielding currency. So effectively, you're buying and earning interest on one currency and selling and paying interest on the other. So the Forex market allows the trader to earn the difference in the interest rates between the two currencies. So the carry of an asset is the positive return earned by holding it. Each country sets its own interest rate based on the money supply and inflation and so forth. So the funding currency has a low interest rate, while the target currency has the high interest rate. So when you're employing the carry trade strategy, you're buying the higher yielding currency and simultaneously selling the lower yielding currency and capturing the interest rate differential. Let's take a look at an example. So for example, if the dollar offers an interest rate of 0 to 0.25% and the Mexican peso yields an interest rate of 5%, someone selling the dollar and buying the peso can earn a profit of almost 5% as long as the exchange rate between the dollar and the peso remains unchanged. Some speculators, in addition to this, hedge their exchange rate exposure, aiming only to capture the interest rate differential. So an interest rate of 4.75% doesn't sound all that interesting just on its own. So what makes the carry trade so special, and why is this something that the big banks and hedge funds were loving in the period up to the financial 2008 and in the 1990s? The reason is leverage. So the Forex market offers an unusually high degree of leverage, and this can be used to amplify the earnings from the carry trade. So let's say you've got a 3% interest rate differential. That's going to generate 300% on an account that is leveraged at 100 to 1. So all of a sudden, you add the leverage, and the carry trade becomes a very profitable, albeit risky trade. The risk in the carry trade is that the currency that you're long and getting the interest from and is yielding the higher level of interest, the risk is that currency depreciates against the funding currency, the currency that you're lending out. And then being highly leveraged naturally magnifies the loss in this scenario. Let's talk a little bit about the characteristics of the markets in which carry trades do well. Carry trades tend to do well in low risk environments. So when investors feel comfortable moving into higher risk, higher yielding assets. So we saw a great period for the carry trade leading up to the 2008 financial crisis, but as soon as that hit, they became impossible basically, as investors flocked to safe haven, low yielding assets. This drives up their prices and makes using them as funding currencies a losing proposition. So in addition, for looking to enter carry trades in a risk-on environment, when money flows out of safe haven funding currencies, investors can enhance their odds of success by being conscious of the broad market trend. So this is looking at the carry trade with the lens of a technical analyst. So an ideal situation is to have an uptrend in the base currency, the currency that you're buying and earning interest on, against the counter or funding currency, the currency you've sold and you have to pay interest on. And another point is, from a fundamental perspective, a good time to enter the carry trade is when the central bank of the currency you're buying is beginning a cycle of raising interest rates. So let's take a look at an example of a chart. We're going to talk about rollover quickly. So the rollover or swap rate, just kind of getting into the technicalities of the carry trade, the rollover is the net interest owed or earned overnight. So swap rates are typically calculated at 5 p.m. Eastern time, and positions held after that time are considered as being held overnight. So these interest rate, what you owe and what you earn overnight, is calculated daily. So let's take a look at the dollar against the Mexican peso. Since all the central banks around the world, I mean, the major central banks have been lowering interest rates so much, even the currencies that are considered risk currencies that historically had higher interest rates, like the Australian dollar and New Zealand dollar, have pretty low interest rates right now. So to pull up an example, I was looking to the emerging markets and to the Mexican peso, which still has an interest rate of 5%, whereas the dollar is at, you know, roughly zero right now, between 0.25%. So if you wanted to employ the carry trade in this situation, you would have wanted to sell the dollar and buy the Mexican peso, right? Because you want to own the peso and earn the interest that the Mexican central bank is offering. So you would have wanted to have been short USD MXN. And let's look at what was going on fundamentally back here. So this is a period, this period here is a period when the dollar was weakening. Why was the dollar weakening during this period? The dollar was weakening during this period because risk appetite was actually increasing during this period. There was hopes about economies reopening, that the coronavirus was being controlled in Europe, and the expectations over how long it would take for the global economy to recover were fairly optimistic. So money was flowing out of the dollar. More recently, though, we've seen risk appetite decline, and we've seen the dollar rise in value again. So a good period to have been involved in this carry trade with the peso, which would have been, it's a highly risky trade because it's an emerging market currency, but just for the sake of an example, would be to have been short here, where you would have earned the interest rate differential and you would have made money from the pair trading lower. So apparently the risk appetite of the market has changed quite dramatically recently. We saw a big sell-off on Friday, so let's see. So not the ideal market environment to enter a carry trade until risk appetite improves again. So with that, I want to wrap it up and thank everyone very much for coming. Please feel free to reach out to me with any questions. You can reach me at dan.blystone@scandinavianmarkets.com. And like I said, I'm here to help and hope you enjoy the rest of the sessions coming up.